Eagle Health Holdings Limited is a Chinese company focused on nutritional products and dietary supplements, which it sells across 23 regions in China, mainly through pharmacies and supermarkets. About 99% of the sales occur through their distribution partners. And the company seeks to list on the ASX by raising between 25 and 30 million at 40 cents a share, which will give the company a market capitalization of between 125 and 130 million dollars. As part of the listing, and that's also the main reason why the company is listing in Australia, the management seeks to set up an office in Australia and starts importing Australian-made products and add them to the product portfolio. The company sells health food products, which are mainly amino acids, protein powder, and throat lozenges, which accounts for about 75% of the company's revenue. Eagle Health is a profitable company that has generated over 80 million in sales and nearly 16 million in profits during the financial year 16. A continuation of this growth trajectory whilst maintaining EBITDA margins at around 28% will eventually result in higher profits. Management, as per the prospectus, targets the distribution of unfranked dividends as early as next year, which will be the primary catalyst. There is negative market sentiment around Chinese listings in terms of governance and transparency related risks, and by paying a dividend, management could really help the Australian market gain confidence in the company's business model, which obviously seems to be working. The store network and the company's distribution partners are penetrating a very large component of the Chinese market, and the company seeks to be growing through three channels, which is further penetrating the existing Chinese market with the three core products, expanding the product portfolio through R&D development, and also adding Australian-made products to the portfolio. So if EBITDA margins can be sustained and revenue continues to rise, inevitably management seeks to create value through that, and by paying a dividend, the Australian market could really understand that the money is real and see how they can benefit from this listing, and that will eventually help the share price perform. Despite sound financials, the primary risk for this listing is the Chinese-based nature of the business. The People's Republic of China is monitoring the money that is leaving the country and also coming in, and we have transparency and governance-related risks associated with this company. Paying a dividend will mitigate some of these risks, but the market is still questioning the sustainability and also the credibility of these Chinese companies listing in Australia. So sentiment as well as future risks related to governance will be a primary hurdle. The IPO of Eagle Health on a macro scale offers Australian investors the opportunity to invest in China, more specifically in Chinese consumer trends, favorable macroeconomic trends, should help this company to bring the product to the market by selling these health foods to the Chinese consumer. On a company-specific scale, this IPO offers exposure to a management team consisting of the founders of the company as well as independent Australian directors, which help with the governance-related risks. This company seeks to list in Australia to expand the product portfolio by selling Australian-made products in China, which have a very strong reputation in the Chinese market. But for me, my personal opinion, the key for this IPO will be to pay a dividend to Australian investors and show them how value can be created. So it is a bit of a test case for a very mature Chinese company to successfully list in Australia.